Hello everybody, so this is the second video associated with chapter 1 of the course. So in the first part we study the forward and futures contract, and we will pursue on this, so we'll continue our examination of futures contracts, and then we'll go on to study option contracts. So last time we saw that for futures contracts, the cash flows occurred throughout the life of the contract instead of simply at the maturity date as for forward contracts. So cash flows, maybe we could go back a few slides. We saw that for a futures contract, at each time step, so at every time greater than T0. So T0 is the inception date of the futures. So at any subsequent time step, the long position of the futures contract receives F bar T plus 1 minus F bar T, where T plus 1 is the date at which the cash flow is received, and T is the previous time step. So these are cash flows received on each time step, which are greater than T0, the inception date. Okay, so furthermore, at the maturity date of the futures contract, the if there's a physical settlement, the underlying asset is exchanged for the final futures price F bar TT. Okay, so these were cash flows of the futures contract, which we defined last time, but we took these futures prices as something given to explain the cash flows, but now we're gonna try to determine how is this futures price determined in practice. So we'll continue here. So we might think that again the futures price could be subjective. There might be many possible values of the futures price, but what we're gonna see is that under some assumptions, if we assume the absence of arbitrage and other conditions, then this futures price cannot be subjective anymore. There's only one possible value of the futures price, which would preclude arbitrage. So this is what we're gonna see next. For the remainder of the study of futures contract, we're gonna assume here a constant interest rate. Okay, then we will discuss what would happen if the rate wasn't constant, but for the sake of this proof, uh, or the sake of discussion here, we will consider a fixed constant interest rate. So under the absence of arbitrage and assuming a fixed or constant interest rate, we're going to see that the only possible value of the futures price here, F bar is the futures price, must be equal to the forward price, which we saw previously in the chapter, which was ST. So previously was ST divided by Z small t capital T, but 1 over Z is equal to the interest rate accrual factor, which is the exponential of R t minus t in the context of constant interest rate. Okay, so to get this result, we say we must assume a constant interest rate R. So R is the continuously compounded rate. And we must also assume that we can store the underlying asset again without any cost. Okay, so in this chapter, we assume everything can be stored without cost for as many times as needed. Then in this case, the only price for the futures on an underlying asset S, which matures at time t, is equal to this relationship. Okay, another assumption, maybe it's not explicitly written here, but we assume that no dividends are paid by the underlying asset. Okay, so the stock we're going to assume it does not pay dividend until time capital T, which is the maturity of the futures. So how can we do that? How can we show that result that the futures price must be equal to the forward price? We're gonna use induction. Okay, so we want to prove this statement above, which is that the futures price here at time small t is the underlying asset price times the interest rate accrual factor between time small t and capital T. So we want to show this for all values of small t, so we'll proceed by induction. Okay, so we'll start uh, with what happens when small t is equal to capital T. So if we're at the maturity at time capital T, if the long position, if somebody enters a long position in the futures, then he will receive the underlying asset and pay the futures price. Okay, so this is the only cash flow at maturity. So in that case, the only cash flow is S capital T minus the futures price. Okay, you give the futures price, so you pay F bar capital T and you receive S capital T. So your net inflow is this thing. Okay, and this thing, it must be exactly zero. Okay, because it doesn't make sense to enter a position, receive a cash flow, receive a positive cash flow, for instance, and then the trade is over, because this would be arbitrage. Okay, so recall that to enter a futures contract, there are no cash flows involved. You can enter a futures contract anytime. So if you enter a futures contract and you just receive a positive cash flow and then the futures expires, then this is arbitrage. It's a free cash flow. Um, so this must be precluded. Okay, so for instance, if the futures price is smaller than S capital T, then you could enter a long position at time capital T in the futures contract, receive the underlying asset, pay the futures price, or receive a net uh, positive inflow, which would be an arbitrage. Conversely, if F bar capital T is greater than the underlying asset price at time capital T, then what you could do, you could enter a short futures position at time capital T. This would entail receiving the futures price at maturity and paying or giving the underlying asset. So in that case, this would be a positive inflow of money. So this again would be some arbitrage. Okay, so at time capital T, the only value which makes sense for the futures price F bar T is the value of the underlying asset itself. Okay, so this works for small t being equal to capital T, the maturity date. But what happens for prior dates? So this is where we're gonna use induction. Okay, so we're gonna assume that at time j, F bar j, the futures price at time j, is equal to st exponential of rt minus j. Okay, so this is our formula for the futures price we had previously, and we're gonna assume that this holds for all j's equal to t plus 1, t plus 2, t plus 3, etc. until capital T. Okay, so this is our induction hypothesis. We're gonna assume it holds for all values of j greater than t, and we want to show that then this implies the statement must be true for j is equal to t. Okay, so let's make this assumption that for all j strictly greater than t, we have this formula that holds, and then we want to show this. So to do that, let's consider applying the following financial operations between time small t and time t plus 1. So let's assume that at time small t, we enter a long position in the futures, and at t we we enter a long position in the futures at time t and close the position in the futures at time t plus 1. Okay, so how do we close a future? We just take the opposite position at t plus 1. Then we're also going to invest this amount of money, in a bank account at time small t, and withdraw that amount of money plus interests at time t plus 1. Okay, so what's this amount? It's st, which is the value of the underlying asset, times exponential of rt minus t minus 1. Okay, so why this factor? This will become clear right in the next slide. And then finally, one last operation we will make at time small t is to sell short. Again, this factor here, which was the same one than here, this factor, which is some kind of accrual factor, shares of the underlying asset at time t. And then because we sell it short at time small t, we have to give it back at time t plus 1. Okay, so we give the underlying asset back at the next step to the person to whom we borrowed the asset. So to give it back, we have to purchase it back on the market. Okay, so let's consider what happens if we apply these three operations at time small t. What are the cash flows associated to each of these operations or each of these trades? So the first position was a long position on the futures. So at the inception of the futures, you have zero cash flows as mentioned previously. And then at the next time step, you receive the time difference between the futures price at the next time step and the futures price at time small t, which is the current time step. Okay. And then there are no subsequent cash flows because we said that at time t plus 1 we close the futures position. So at subsequent periods there are no cash flows remaining. Then the second operation we made was to sell short the underlying asset, and how many shares we sold short? This amount, this number of shares of the underlying asset. So the cash inflow at time small t is the price of the underlying asset times the number of shares here. And why is this an inflow? It's because when we sell it short, we sell it on the market, so we receive the proceedings of the sale, okay, which is the current price of the asset on the market times the number of shares. So then, because we've shorted it at the next time period, we said we have to give it back. So because we've shorted this number of shares, we have to give back the same number of shares at the next time step. So at the next time step, we give back the same number of shares. The minus here says we have to give it back, so we have to purchase it to the market. And by purchasing it, we have to pay the market. Okay, so this is where the minus sign comes from. It's because it's an outflow of money because we have to purchase the asset back. And then, so this is the number of shares times the price of the asset on the market at the time it's repurchased, which is st plus 1. And finally, the last operation is to put money in the bank and accrue interest on it. So we said that we're gonna deposit this amount. Okay. Let's not consider the minus sign, but let's say we deposit this amount of money in the bank. Because we deposit it in the bank at time small t, it's a cash outflow. So this is where why there's a minus sign, because we give the money to the bank, and then at the next time step, we receive the same amount of money where we add interest for one period. Okay, so we multiply this amount by exponential of r. So the minus 1 here disappears as we multiply this guy by exponential of r. So this is why we get that cash flow. So the net cash flow from all operations is the following. So at time small t, there are zero cash flows. And at time t plus 1, here's the net cash flows. So let's copy that and paste it on the next slide. Okay, so this is the formula for the cash flow at time t plus 1. Furthermore, what can we do here? we can replace f bar t plus 1 by the futures price according to our induction hypothesis. So at t plus 1, we said that the futures price could be given by this. Okay, so this is simply replacing J in the previous slide's formula by t plus 1. So we can replace this by this, which is the induction hypothesis. And then what happens here, this term, the first term and the third term, they cancel out. So what's left here is those two guys. Okay, so minus the futures price at time small t plus st times the accrual interest rate, interest accrual factor. Okay. Furthermore, although this cash flow is paid at time t plus 1, this is something that is known at time small t. Okay. So the futures price at time t, it's known by time t, and the underlying asset price at time t, it's already known at time t. So we don't have to, although the cash flow is paid at time t plus 1, we don't have to wait until t plus 1 to know its value. So what would be the only value which would make sense for the futures price here? Well, it would be the value which would make the cash flow, the net cash flow, total cash flow equal to 0. Why is that the case? Well, at time t, there's a 0 cash flow, so the only cash flow is at time t plus 1. So if you have a positive cash flow at t plus 1 and you know it already at time t, then you're going to make the following trades we propose and just get a positive amount of money at time t plus 1 without any risk, because this cash flow is already known by time t. So this is an arbitrage opportunity. Okay, so the only possible value for the futures price is the value which makes this guy, this whole quantity equal to 0. Okay, so let's repeat. The time t cash flow is null. So to avoid this being an arbitrage opportunity, the cash flow at time t plus 1 must also be null. Okay, and this is true because the cash flow at t plus 1, we said it's known by time t. Okay, so if it wasn't known at time t, it would be random as of time t. Then you could have a cash flow which would have a positive probability of being positive and a positive probability of being negative. So this would not be arbitrage, but the cash flow at time t plus 1 is known by time t, so it must absolutely be equal to 0. And this implies that the futures price at time small t is equal to the underlying asset price times the interest rate accrual factor, which concludes the induction. Okay, so if we go back to the previous slide, what we just showed here is that if there's a deterministic interest rate, if we assume the absence of arbitrage, if we assume that the underlying asset is perfectly storable without cost, if we assume that the underlying asset does not pay dividend before time capital T, then the only possible futures price is equal to this guy, which is exactly equal to the forward price of the underlying asset. Okay, so this is a nice result. Then furthermore, another interesting result is that if you have, let's say we're still working in the context of constant interest rate, it's possible to replicate the payoff of a forward contract by a suitable portfolio of futures contract. Okay, so we will see what I mean by a portfolio of futures contract. It's just a number of futures contract that is adjusted through time, and if we adjust the number of positions of the futures contract suitably through time, we can replicate the payoff of a forward position. Okay, so this shows that in practice, it's redundant if you assume constant interest rate. It's redundant to have both a forward and a futures contract because one can lead to the payoff of the other. Okay, so this is why in practice, on some products, we typically have only a forward price or a futures price. We typically don't have both. Okay, so how do we do that? We're gonna show that if on all time periods going from time j minus 1 to j, if we hold exactly theta j being defined as this, so theta j is defined as exponential of minus the risk-free rate times the time difference between capital T and j. If we hold this number of long positions in the future during the time period from j minus 1 to j, for all time steps j, okay, so for all j go from t plus 1 to capital T, then we're gonna see that the payoff of this futures portfolio will be exactly equal to the forward contracts payoff. Okay, so let's show that right now. So here, what is if we do that as suggested above, what is the payoff from the futures portfolio? Well, at time capital T, the cash flow here is equal to theta capital T. This is the number of futures position we have when we reach time capital T, times the cash flow at time capital T, which is if you're the long position, you pay the underlying asset or you give the underlying asset and you receive the futures price as maturity. Okay, so this is the cash flow at time capital T. Furthermore, theta capital T, if we just replace j here with capital T, this theta here becomes 1. Okay, so this is equal to 1. Plus, for all prior time steps, the cash flows associated to the portfolio. So for any time step j, you receive theta j, the number of futures position you hold from time j minus 1 to j, times this is the cash flow at time j for a single futures position. So this is the time difference between the futures price. If this is what we defined as the cash flow for a futures contract. And here, because this cash flow is received at time j, at time capital T, this amount of money will accrue interest according to our deterministic rate. So we must multiply this amount by the exponential of r times t minus j, because this amount of money received at time small j, if we accrue it to time capital T, then we must multiply by this. Okay, so then to go from the first line to the second line, we notice that this is equal to 1, so this disappears. And furthermore, we can replace this theta j by this amount here, which was the definition of theta j. Okay, so if we do that, then this exponential and this exponential here, they cancel out. So what we obtain ultimately is the following quantity. And we can see that this again is a telescopic sum. So if we sum all the terms here, the only thing remaining is plus the last term of the sequence of f bar minus the first term of the sequence of f bar. So this will be, this whole sum will be equal to f bar capital T minus f bar T0. Okay, so doing that, noticing that the previous sum is telescopic, we can replace the sum with that. These two guys cancel out. And here, the only two remaining terms is the first one and the last one. And we saw that the futures price at the time t0 must be equal to the forward price at time t0. So this is the theorem we just showed previously. And this is the payoff of a forward contract. Okay, so we can see that if you have a suitable portfolio of futures contract where you rebalance the position according to this rule, so at all time j minus 1, you make sure that your number of long futures positions outstanding is equal to this quantity, then the payoff of the futures contract will be exactly equal to the payoff of the forward contract. Okay, and again, this is assuming a constant interest rate. This is the assumption we made. Okay, so this constant interest rate business, well, we might agree or argue that it's not 100% true, because in practice, interest rates, they fluctuate through time randomly. So we cannot predict in advance what will be interest rates in 1 year, in 2 year, etc. Okay, so in the case of random interest rates, it's harder to determine what would be the possible prices for the futures contract. Okay, so we could ask ourselves, what are the futures possible prices of the futures contract at time t, which do not lead to arbitrage, and this is more complicated. If you do advanced classes in quantitative finance, there's a theory for that is well developed, but we shall not study it in depth here. However, we'll still discuss some qualitative adjustments that would need to be made on futures prices if interest rates were random. Okay, so one key aspect to consider when interest rates are random for the pricing of futures is the correlation between interest rates and cash flows of the future. Okay, and cash flows are the future are basically variations or increases in the underlying asset price. So the first case that we have to consider is what happens if the interest rate is positively correlated with the underlying asset. Okay, so what happens if interest rates tend to go up at the same time than the underlying asset, or the stock underlying the futures? Then, so if the stock goes up, the long position receives a positive cash flow, and interest rates jump at the same time, so he'll be able to make more money on his cash, the cash flow he received. Okay, so this is a good news for the futures contract holder, because receiving the money early for a futures contract gives him the opportunity to accrue more interest rate, because the interest rates increase at the same time. Okay, so when interest rates are positively correlated with the underlying asset, cash flow received will be associated with a larger accumulation on interest rate. Conversely, when there's a negative cash flow, okay, so let's say the stock price plunges, then there will be a negative cash flow, so the long futures position will have to pay some amount of money. But in that case, because the stock plunged, typically interest rates will plunge also. So this negative cash flow is associated with a small amount of interest. Okay, so small interest rate. So it's not it's not as problematic to pay a cash flow right now instead of at the maturity, because you will pay less interest rate on it. Okay, so if we're in that case where the interest rate is positively correlated with the underlying asset, then the holder of the long position will prefer futures to forward contracts, assuming they have the same price. And why is that the case? Well, it's because when rates are positively correlated with the underlying asset, you prefer receiving cash flows as early as possible. Okay, because if you have a positive cash flow, more likely you'll receive a lot of interest on it. If you have a negative cash flow, then you forfeit a small amount of interest on it. Okay, so this is preferable to have your cash flows early when interest rates are correlated with the underlying asset. Conversely, if you're the short position, it's exactly the opposite. Okay, so if you're a short position when interest rates go up, it means that the stock goes up also, so you have to pay a cash flow. Okay, so you pay a cash flow when interest rates are very high, and you will receive cash flows when interest rates tend to be small. So this is not interesting to receive your cash flows right now. You'd rather wait for the cash flows to be paid at maturity, because you cannot accrue a lot of interest on your inflows, and you lose a lot of interest when you pay money. Okay, so for this reason, futures, if interest rates are positively correlated with the underlying asset, the long position will prefer futures to a forward, whereas the short position will prefer forwards to the futures, assuming the price of both derivatives is equal. Okay, so in that case, this means that to compensate the short position, the futures price will be higher than the forward price. Okay, so when interest rates are correlated to the underlying asset, the futures price should be higher than the forward price. Conversely, if interest rates are negatively correlated to the underlying asset, the opposite mechanism occurs, and the futures price will tend to be smaller than the forward price. Okay, so this, I explained it without drawing picture or without writing, but you should take a moment, stop here, take a sheet, and try to write down example of cash flows where you have two cases. Let's say interest rates are high and low, and what happens when they increase, what happens when they decrease at the same time than the stock. So to convince yourself that what I just said is true. Okay, so what I just said is pretty complicated because there are many cash flows, correlations, positions involved. So take some time, please, to reflect on this and before going on to the next topic. Okay, so now we've completed the study of forward and futures contracts. Now we'll go into studying options. So what is an option? An option is an agreement between two parties or two institutions which gives the first party the right to purchase from or sell to the second party some asset at a predetermined date and a predetermined price. Okay, so the choice to exercise the option, so to make the exchange of the underlying asset and the strike price or the predetermined price, is always at the discretion of the first party. Okay, so what is the difference between an option and a forward contract? In a forward contract, the exchange of the underlying asset for the predetermined price is certain to happen at the maturity. Okay, both parties are forced to make that transaction. For the option, the exchange of the underlying asset versus the predetermined price, which is the strike, will occur only if the buyer of the option says it will occur. Okay, so the buyer of the option can decide to say, okay, I don't want to make the exchange at the maturity date, and then the option expires and there's no exchange made. Okay, so the decision to make the exchange or not is at the discretion of the first party. Okay, which is who is called the option buyer. Okay, so in that previous case, the first party, which can decide whether the trade will occur or not at maturity, is called the option buyer, and we say he holds a long position on the option. The second party, which is the option seller, holds a short position on the option. Is said to hold a short position. Okay, so the long position is the person who decides, or the institution who decides whether or not the exchange will occur, and the short position is forced to obey what the long position decides on the maturity date. So the predetermined price of the trade is called the strike price. The predetermined date of the trade is called maturity. And one quick detail here, if we go back one slide, here I wrote predetermined date or a date within a predetermined set of dates. Okay, so some options say, okay, if you want to do the trade, it must be exactly this date, for example, September 1st, 2021. Or some other options, they allow for multiple dates. Okay, so the option buyer can decide to buy, let's say, at any date until September 1st. Okay, so this, in that, the latter case, it would be a set of possible buying dates instead of a single possible date. Okay, so here the maturity date of an option, if there's a single possible date for the trade, that date is called the maturity. But if we have a set of possible buying dates, then the maturity date will be the last date among this possible set of dates where the exchange can occur. So here, a call option is an option which allows the option buyer to buy the underlying asset at the strike price, whereas a put option is an option which allows the buyer to sell the option at the strike price. Okay, so a call option allows you to call the underlying asset. A put option allows you to sell or to put the underlying asset to the counterparty. Okay, so a bit of terminology. We have what we call European option and American options. Okay, so European and American, it's not related to, let's say, a European option is an option sold on European exchanges. Okay, so it's not related to the location of the underlying asset or where you buy the option. It's associated to the following feature. A European option is an option which allows to purchase or sell the underlying asset at a single date. Okay, so when you have a European option, if you're an option buyer, you can decide whether or not to make the exchange at a single fixed date. For an American option, the purchase or the sale of the underlying asset can be made at any date until the maturity. Okay, so for example, any date from now to the maturity date, the option buyer can decide to say, okay, right now we're going to make the exchange of the underlying and the strike price. Some more terminology. For a call option, an option is said to be in the money if the current value of the underlying asset is greater than the strike, or out of the money if the underlying asset is smaller than the strike. Okay, so typically, if you hold a call option, if you're the option buyer of a call option, you can buy the underlying asset at the price K. So because of that, you certainly hope that the underlying asset price at the maturity date will be bigger than K. Okay, because if it is, then you can buy the underlying asset at K, which is more favorable than if you did that on the market, because the underlying asset price is more expensive than K. Okay, so this means that if the underlying asset price is greater than K, you're more likely to do some money by the time the option expires. So this is why we call it in the money. Conversely, if you hold a call option and the underlying asset is below the strike price, you're less likely to make money when the option expires, because the underlying asset will not go above the strike price. So this is why we call it out of the money. Conversely, for a put option, it's the opposite. So if you hold a put option, the option is said to be in the money when the current underlying asset price is smaller than K, the strike, or out of the money if the underlying asset price is greater than K. For both options, if S is exactly equal to K, we say that the option is at the money. Okay, so right now, you can memorize this terminology, but we're going to study some examples either during the lectures or in the exercises to try to understand this terminology and see why it makes sense to call it in the money or out of the money. Okay, so let's give some example. Assume that we have some institution A which has purchased an option. So institution A is the option buyer, which allows it to purchase the stock from a company X. So the company X stock would be the underlying asset from institution B on January 1st, 2025 at the price of $110. The underlying asset price is currently $100 on the market. So the current price of company X stock is $100, but you can purchase the contract. Option contract allows the institution A to purchase it at $110 in the future. So here, what is the option type? The option type is a European call option. Because why European? It's because there's a single possible date at which the exchange of the underlying asset versus the strike price can occur. And why call option? It's because the institution A, which makes the decision to make the exchange or not, is entitled to buying the underlying asset at the strike price. Okay, so it can receive the strike price, receive the underlying asset and pay the strike price. So because it can buy the underlying asset, we say it's a call option. Conversely, if the institution A could have sold the underlying asset, then this would have been a put option. What is the strike price here? The strike price is $110. It's the price at the predetermined price at which the transaction can be made according to the contract. And in this case, the option is out of the money because we have a call option where the strike price is greater than the current price of the underlying asset. Okay, so for the buyer to decide to exercise the option, it would make sense only if the underlying asset price would be bigger than $110 at maturity. So because the current price is it's less likely to reach this level because it's currently below it, we say that the option is out of the money. What's the underlying asset here? It's the stock of the company X. The long position or the option buyer is institution A because it's the institution which can decide whether or not the exchange will be made, whereas the short position holder or the option seller is institution B. So it's because according to this contract, institution B has no decision to make whether the exchange of asset versus strike will be made or not. Okay, so this decision is made by institution A, so institution B, which decides nothing, is said to be the short position or the seller of the option. Okay, so when you buy an option, you have a right to decide whether or not some exchange of assets will be made. So whether or not you give or sell some underlying asset and receive or give the strike price. So because you can make that decision in the future, this will give you potential positive cash flows, but no negative cash flows in the future. Okay, because if the exchange would entail a negative cash flow, or then you would just not make the exchange. Okay, so if you're institution A in the previous example, you have the potential to receive positive cash flow, but you will never receive negative cash flow. So for that, institution B needs to be compensated for that. Okay, so to get that right, institution A will pay at the inception of the contract some amount to institution B, and such an amount of money is called either the option price or the option premium. Okay, and this is different than for forward and futures contracts. So for forward and futures contracts that we've studied earlier, entering in a forward or futures position does not entail uh, giving an immediate cash flow. Okay, so you can enter a futures position without paying any cash flow uh, on the date you enter the position. For an option, it's different. If you purchase an option, you have to pay the premium uh, to the option seller. Okay, so the option seller receives the premium. So when you enter into an option contract at the inception date, there's an immediate cash flow associated to that transaction. Okay, so this small picture illustrates the cash flow. So if you're the option buyer, then at the initial time step or the inception, you purchase the option, so you pay a premium. You pay a premium to the option seller, and then at the time of the exercise, so if you decide to exercise the option at some point, then the okay, I'll do it for the call option, but it's the opposite for the put option. So if you're the buyer of a call option, then you can pay the strike price on the exercise date and receive the underlying asset in return. Okay, and this option exercise date is decided by the contract, but so let's say we have a European option, this date is fixed, but at that date, the option buyer can decide whether or not this exchange will be made. Okay, so if he decides not to make the exchange, then at this date there will be zero cash flows. Okay, so now we'll define mathematically the payoff of options. Okay, so we're going to start with the call option and then we'll illustrate the case of a put option. Okay, so at the maturity date, capital T of a call option, if the underlying asset price is greater than K, then you have a possibility of paying K and receiving the underlying asset. So if you're the buyer, this is a good deal because you'll receive something that is worth more than what you will have to pay. So you will decide to enact the transaction, and the net amount of value you will receive is ST minus K because you receive this and you pay this. Okay, so if you're the buyer of a call option at the maturity date, or you will, and if, sorry, let's start that again. If you're an option buyer at the maturity date of an option, which is capital T, if the underlying asset price is greater than the strike, you will enact the transaction and receive ST minus K. Conversely, if the underlying asset value is smaller or equal to K, you will not make the transaction, because if you wanted to receive the underlying asset, instead of paying K for it, because its value is smaller than K, you'll simply go to the market and pay an amount of money which is smaller. Okay, you'll pay S capital T instead of paying K. So it doesn't make sense to make the exchange and pay K for an asset that is worth less than K. So in that case, if you're the option buyer, you'll decide to let the option expire without exercising it, so without enacting the exchange between the underlying asset and the strike, so you will not receive anything. Okay, so this says that these facts entail that the payoff of a long position on the European call option is the following. So if you're the option buyer of a European call option, your payoff is the maximum between 0 and S capital T minus K. So this is equal to ST minus K if ST is greater than K, or 0 otherwise. Which means that if the underlying asset is worth more than the strike at the maturity, then you will enact the trade and receive the difference in value. Whereas if the underlying asset is worth less than the strike, then you will not enact the trade and the option will expire without without any cash flow being exchanged at time capital T. Okay, so this is the mathematical formula for the payoff of a European call option. Now, can we say something about the put option? So assuming again we have a European put option, then at maturity T, so if you're the buyer of the option, you have a possibility to receive K, receive the strike, and give the underlying asset in exchange. Okay, so if at the maturity K is greater than ST, then the option buyer will decide that the trade will happen. He will receive K and give the underlying asset, which is worth ST. So in total, he will earn the value of that exchange would be K minus ST. This is the value of what he receives, the value of what he gives, and in this case, this cash flow would be positive. Conversely, if at maturity the underlying asset is worth more than the strike, then the option buyer will let the option expire without exercising it, and there will be no cash flow at maturity associated to the option. Okay, because if the underlying asset value is greater than K, it doesn't make sense to give it for K dollars. Instead, you would go on the market and receive more than K dollars for the sale of your asset. Okay, so it doesn't make sense to exercise the option in that case. So this means that the payoff of the long position on the European option is equal to maximum between 0 and K minus ST, which is K minus ST if K is greater than ST, so if the strike is greater than the underlying asset value at maturity, and 0 otherwise. Okay, so these were payoffs defined for European options. So for European options, we gave a formula for the payoff at maturity. Now, what happens for American options? Recall, American options are options which can be exercised at any date prior to the maturity at the discretion of the option buyer. Okay, so for an American option, the option buyer decides not only if the exchange will be made, but he also decides the date at which the exchange will be made. So at each date, he can decide, okay, I'm going to exercise my option or I won't. So here, in that case, for an American option, tau, let's denote by tau the time at which the option is exercised. So typically in those cases, tau would be a random variable because we don't know in advance when the option buyer will decide to exercise his option. But in that case, for an American option, the payoff for the long position on the American option is given by the following formula. So for a call option, it looks like the same formula, so it's still S minus K, but instead of having S capital T, it's S capital tau. Okay, so the value of the underlying asset the buyer receives is S tau. It's the price of the underlying asset at the moment the option is exercised. And here, this is multiplied by some indicator tau is smaller or equal to T, which means that This guy, this tau smaller or equal to t means the exercise date is made before maturity. So what would tau greater than t say? It would simply say that tau, the option is not exercised. Okay, so this quantity would be 0 if the option is not exercised ultimately by the maturity date. But if it is exercised, then this guy is equal to 1, and the call option buyer would receive S minus K, but S at the time of the exercise. Conversely, the put option here would have payoff K minus S tau if and only if the option is exercised. And again, for the American option, the payoff is not received at the maturity capital T. It is received at time tau, which is the moment at which the option buyer decides to exercise his option. Okay, so here we graphed the payoff for the buyer of a call option and the buyer of a put option. Okay, so here for a call option, let's say this is a European call option. We said that the payoff is equal to the maximum between 0 and st minus k. Okay, so in this axis it's st. This is the value k here. So what happens is if S capital T is smaller than K. So if we're in this region, the underlying asset at maturity is smaller than K, then the option is not exercised. The call option expires without being exercised, so the payoff is 0. But if the underlying asset ST is greater than K, so if we line this region at the maturity date, then the option is exercised and the buyer of the option receives ST minus K, which is the difference between the underlying asset and K. So in that case, the function ST minus K is simply a straight line here. Okay, so we can see that the payoff of a call option has the shape of a hockey stick. Conversely, for the put option, if we plot the payoff function we had earlier, the payoff takes the following form, which is again some type of hockey stick. So if at maturity the underlying asset is smaller than K, then you exercise the option and you receive K minus ST. So this segment here represents the function K minus ST as a function of ST here. And if ST at maturity is greater than K, then you don't exercise the option and your payoff in this region is 0. Okay, so these two plots, they represent the payoff of options as a function of the underlying asset. Okay, so now we discussed regular option or standard options, which are often referred to as vanilla options. In practice, we have some options that are more complicated than the one we've studied, and these are typically referred to as exotic options. Okay, so exotic options have features similar to vanilla or standard options, but they have some features that are a bit more complicated. So this is why we call them exotic, okay, because they're not traditional options. So in the few next slides, we're going to give some examples of exotic options, but in practice, although they exist, they're not as common as vanilla options. Okay, so options the most often seen and traded are vanilla options, but sometimes, for some reason, some institutions they might want to trade or to hold options that are tailor-made to their needs, so they sometimes buy exotic options. Okay, so the first option we can that is exotic and that we can consider here is the chooser option. A chooser option is an option which lets the buyer determine at the maturity date whether his option is a call or a put option. Okay, so here in that case, if your payoff is a call option, recall the payoff is maximum between 0 and st minus k. And conversely, if you're a put option, your payoff is maximum between 0 and k minus st. Okay, so you can go back the slides to look at the payoff. So when you have a chooser option, your payoff will be the maximum between the payoff of a call and a put option, because you can elect if your option is a call or a put. And it turns out the maximum can be expressed as this. This is the maximum between st minus k and k minus st. Okay, so this is the first type of exotic option that we can study. Second type of options is an agent option. So agent options are options whose payoff depends on the average value of the underlying asset over some predetermined time period. Okay, so the average of the underlying asset price over that predetermined time period is denoted as average. Okay, so there are two types of agent options. There are what we call average price and average strike call options. So either average price or either average strike. So here, for an average price agent option, its payoff at maturity is simply expressed by replacing ST, the maturity date underlying asset, by the average. Okay, so for a call option, instead of having maximum between 0 and st minus k, you have maximum between s average minus k and 0. Okay, so here for average price agent options, the payoff is the same than vanilla options, except S capital T is replaced by S average. So instead of receiving the underlying asset at maturity, you receive an amount of money which is equal to the average value of the underlying asset over that time period. So same thing for average strike. You still take the regular call option formula for the payoff, but instead of having K, a strike K, you replace K by the average. Okay, so for a call option, it's maximum between 0 and ST minus S average. Okay, so K is replaced by S average, and same thing for the put options. It's maximum between 0 and S average minus ST instead of being K minus ST. Okay, so maybe one detail, I'm not sure if I talked about it, but again, options, the settlement can be either physical or financial. Okay, so if you have a physical settlement, let's say you have a call option, then you would pay the strike and receive the underlying asset. But if you have a financial settlement and you exercise the option, you will pay the strike, but instead of receiving the underlying asset, you'll simply receive S, an amount of money equal to the value of the underlying asset. Okay, so physical settlement, you receive the underlying asset. Financial settlement, you receive an amount of money equal to the value of the underlying asset. So we can see here that these agent options would be options with financial settlements, because you cannot receive an average of the underlying asset value on each day. It doesn't make sense. So instead, it's an amount of money equal to the average that is paid if the option is exercised. Okay, so here this S average guy, it's the average over some period, but in the practice, or at least in the literature, there are two ways to compute that average. The first is what we call the arithmetic method, and the second way to compute the average is called the geometric method. Okay, so suppose the average is calculated over a set of dates t1 to tn. Then the arithmetic average of the price would be kind of the regular average, what we're used to calculate when we calculate average. So S average would be the arithmetic average, which would simply be 1 over n times the sum of prices on each of the days. Okay, so this is kind of the regular average we're used to calculating, but there's also what we call a geometric average. So here, in that case, the geometric average would be equal to the product, instead of the sum, of the prices at each date, and you take the capital N root. Okay, so this to the power 1 over n, so it's root n of this product. Okay, so in the contract, if you want to use the geometric average instead of the arithmetic average to compute the average, it would be specified. Okay, so the rule to, if you go into an option contract, subscribe to an option contract, rules to calculate the average are specified in there. Now, a quick comparison, we always have that the arithmetic average is greater or equal to the geometric average, and this result can be obtained through applying Jensen's inequality. Okay, so we won't do this calculation here, but this is good general knowledge to have. An arithmetic average of quantities is always greater or equal to the geometric average. And for that, one assumption we made is that the price of the asset is always non-negative. Otherwise, it might not make sense to compute this guy here. Okay, another type of exotic options is compound options. So a vanilla option, let's say we have a call option, it allows receiving the underlying asset at a future date for the strike price. Compound options, instead of allowing receiving the underlying asset, it allows us receiving an option over some other underlying asset. So for a compound option, the underlying asset is another option on some other asset. Okay, instead of being an underlying asset directly, a compound option allows you to receive an option for the strike price, and that other option has some other underlying asset. So it's kind of this is why it's a compounding option. It's an option which allows you to buy an option at a future date and a future predetermined price. We have also look-back options. So we talked about Asian options, which involve the average price of the underlying asset across some period of time. While look-back options, they depend on the extremum of the underlying asset price instead of the average over some period. Okay, so extremum, it's either a minimum or maximum. So here are examples of payoffs associated to look-back options. So a look-back call option payoff is equal to ST minus the minimum of the underlying asset price over some time period until the maturity date. Okay, so this quantity, of course, the minimum is always smaller than ST, so this quantity is always positive here. Okay, so a look-back call, it replaces K by the minimum value of the underlying asset over the life of the option. Standard look-back put, again, it replaces K by, here, it's the maximum instead of the minimum. Okay, so the standard look-back put replaces the strike price here by the maximum of the underlying asset over some time period. And again, this quantity, it's always positive because the maximum over the price over some period must be, of course, greater or equal to the last value of the price. Finally, we have other types of look-back options which are called extrema look-back options. So for an extrema look-back call, instead of replacing K, we replace ST by the maximum. Okay, so for an extrema look-back call, the payoff is maximum between 0 and the maximum of ST between time 0 and the maturity minus K. So here we need to have maximum between 0 and this guy because this maximum, it's not guaranteed to be greater than K. Okay, so for this reason, because this guy is not guaranteed to be greater than K, we have to take the maximum between 0 and that to ensure that the total payoff is greater than 0. Finally, we have extrema look back put, where the here it's again the payoff is exactly like the formula for a put option, but instead S capital T, the underlying asset value at the maturity, is replaced by the minimum of the underlying asset value across the period between time 0 and time capital T, which is the maturity of the option. Okay, so we can see that look back options have payoffs which depend on either the maximum or the minimum of the underlying asset over some period. Okay, we have shout options also. So what's a shout option? It's an option where the holder can lock, we either say lock or shout, the minimum value for a payoff at some time tau. Again, tau is elected by the option buyer, tau before maturity. Okay, so assuming the option buyer shouts the option at time tau, then it locks the payoff, option payoffs at that date. But what do we mean by locks here? It locks the minimum possible value of the payoff. And then the payoff is only paid at maturity, but the payoff at the maturity is the maximum between the payoff of a regular option and the payoff which would have occurred at the shout date. Okay, so if you have a call option, the payoff is the maximum between 0, ST minus K, which is the regular call option payoff, and S tau minus K, which is the what would the payoff had been if the option matured on time tau. Conversely, the payoff of a shout option, if you have a put option, the payoff at maturity is maximum between 0, K minus ST, and K minus S tau, okay, which is the time at which the option was shouted. Okay, so although you can lock in the payoff to a minimum value at the time tau, for shout options, the payoff is still received at time capital T at the maturity. So if you shout an option earlier, then you don't receive the payoff right now, you only receive it at maturity. Okay, so if the holder of a shout option never shouts the option, then the payoff, this part here would disappear, and the payoff would be simply the same than the payoff of a regular call or put option. There's also what we call forward start options. So these options are options where the strike is unknown at this inception of the contract, and it's both parties agree that the strike price will be set at the underlying asset price at a predetermined subsequent date. Okay, so here for a forward start option, in the contract it's written that at some date T1, which is earlier than the maturity, then at this date we'll look at the underlying asset price on the market, and this underlying asset price will serve as the strike price. Okay, so T1 here is called the fixing date, and then the payoff provided by the option at time T is the same payoff than for a regular option. So for a call or for a put option, it's the same payoff, except the strike price here, K, is replaced by the value of the underlying asset at the fixing date, T1. We also have what we call barrier options. Okay, so barrier options are options where the payment of the payoff is conditional on some threshold being reached by the underlying asset throughout the life of the option. Okay, so for example, we have what we call knock-in options. So these options, they provide a payoff analogous to a call options, to a call or put option, so analogous to vanilla options. But knock-in means that the option payoff is provided only if some barrier or some threshold is reached by the underlying asset throughout the life of the option. Okay, so if, for example, there's an upper threshold, we have a knock-in option. So the payoff is said to be provided if and only if the underlying asset knocks the barrier, so it reaches that threshold. So if it reaches that threshold throughout the life of the option, then the option will provide the payoff. But if, for instance, the underlying asset remains below that threshold for the whole duration, then no payoff will be provided by the option. Okay. So conversely, knockout option is the opposite. It's an option which promises a payoff, but if the underlying asset value reaches some threshold, then the payoff is canceled. Okay, so the payoff is provided only if that threshold is never reached by the underlying asset throughout the life of the option. Okay, so for example, I give what we call a down and out barrier call option. So here for a down and out barrier call option, the option payoff at time capital T is the same than for a regular call option with strike K1. But here the payoff is provided if and only if the minimal value of the stock throughout its life remains above K2. Okay, where K2 here, it's a constant smaller than K1. Okay, so basically there are two thresholds, K2 and K1 here. So if at some point of the life of the option, the underlying asset price touches K2 or reaches this threshold, then the option price will provide no payoff. Okay, but if it remains over K2, then it will provide a payoff provided that the option is exercised, so provided that the option ends up above the K1 threshold. So this is called a down and out barrier call option. Of course, there are other types of there are 8 types of barrier options. So barrier options can be either call or puts, so 2 types. They can be knock-in or knockout. So again, 2 other ways to classify it. And they can be either down and out or up and out. Okay, so or down and in or up and in. Okay, so down and out means that the threshold is a downward barrier. Up means that the threshold is an upward barrier. So in that case, you have either call or put, so 2, either down or up, so times 2, and either out or in, so times 2. So in total, there are 8 possible types of barrier options. You also have what we call exchange options. So exchange options, they involve exchanging one asset for the other instead of exchanging an asset for a given amount of money, K. Okay, so here in that case, the strike price is replaced by some other asset. Okay, so for example, in the exchange option, if you're the buyer, you're allowed at the maturity date to receive an asset S1 or S2 and give an asset S1. Okay, so if you have a European call option on asset 2 with strike asset 1, then the payoff at maturity, it's the maximum between 0. So 0, it's if the option is not exercised. And if the option is exercised at maturity, then the payoff is S2 minus S1, meaning that you receive the asset S2 and you pay the asset S1. Okay, so that option pays off the difference in value between 2 assets if this difference is positive. There are also what we call rainbow options. So rainbow options are options whose underlying asset depends on multiple securities. Okay, so for example, if the payoff if we have many risky assets, so let's say we have capital M different stocks, stock S1 until stock SM, then we could define something like this stylized ST could be some function F of the prices of all the assets. So function F can be determined in the contract. A common example for F is simply the average of all the prices of all assets. So if F is an average, then the rainbow option is called in practice a basket option. And then in that case, a European rainbow call option would be an option with exactly the same formula than for a regular call option, except that the price of the underlying asset is replaced by the value of that function of prices of all assets. Okay, so for example, if you have a rainbow basket option, basket call option, then at maturity, you would receive, if you exercise the option, the average price of many assets minus the strike price. Okay, so rainbow options are options whose payoff depend not only on a single underlying asset but on multiple underlying assets. So we can see that the exchange option seen previously could be understood as a particular case of an option, a rainbow option, if you set the strike to 0 and if you set that function S to the difference between two assets. Okay, so we've seen many types of derivatives, forwards, futures, options, so regular or vanilla options, and many types of exotic options. So it's great, but what's the use of these contracts in practice? Well, there are three main uses of these contracts by institutions in the practice. Okay, so the first use is risk management. Okay, so for example, options, they provide payoffs which are contingent to certain situation occurring. So for example, they provide a payoff if the stock price increases below some threshold or goes increase beyond some threshold or goes below some threshold. So they pay cash flows contingent to some situation. So sometimes they can act as some form of insurance, and financial institutions would use that for risk management purposes. Another use of derivatives is speculation. Okay, so for example, if you think that the stock market will go up, well, you might want to buy a call option hoping that the payoff will be positive and that you will profit from this. Okay, so speculation is a second use of derivatives. And the third one is arbitrage. Okay, so we've defined informally arbitrage in the previous chapter, but in some situations, people might observe some pricing anomalies on the market, so the price of some assets might be too high or too low with respect to what they should be. So in that case, sometimes there are trading strategies using options which can allow profiting from these pricing anomalies. Okay, so this is a third use of derivatives, sometimes profiting from these arbitrage opportunities or anomalies requires the use of some derivatives. Okay, so in the next slides, we're going to illustrate many examples of risk management and speculation strategies relying on derivatives, but this we will do in the next video. So thank you for listening, and we'll keep up with upcoming videos.